Hi, I'm Max Keiser. This is the Keiser Report. The frauds get more brazen. The amounts being stolen get bigger. Regulators are now just walking away as total financial chaos envelops the globe. Stacy.
Yes, Max. It's a tale of the good, the bad, and the shring. And I want to cut to this little clip here that was made by RGB Anarchy. And to set the scene for you, Max, Jamie Dimon is gathering up the silver to cover all his naked shorts, and in comes...
It's all ours, bloody! You're joking, Blondie. You wouldn't play a joke on me like that.
It's no joke, it's a rope, Tuco. I want you to stand up there and put your head in that noose.
Yes, Max, it's Sheriff Shring Keiser. Well, you know, there's another success in the whole good, the bad, and the shring market, and that's congratulations, Occupy Wall Street. You're officially making companies scared. The CME Group, in their Take-Q filing, noted these risks. In connection with the continued economic uncertainties, groups such as Occupy Wall Street and Anonymous have targeted the financial services industry as part of their protest against the perceived lax regulation of the financial sector and economic inequality.
Yes, exactly. This is fantastic news because the Occupy Wall Street movement and Anonymous needs to get that word risk and risk adjusted and risk factor in as many financial documents as possible. The CME out in Chicago, they're not regulating anybody that they're supposed to be regulating. That's incredible risk to the overall economy. And of course, I saw the headline of Business Insider, and I think that the reason they put that up there was to suggest that, oh, Occupy Wall Street, now you've gone and done it. You've actually caused the poor CME group to have to suffer some kind of disclosure that they are in fact terrorists. Oh.
Well, we're going to go over two headlines now, Max, which will show that, in fact, they are, okay? Because they mention that it's perceived lax regulation, that these protesters perceive them as having lax regulation. Well, let's look at the reality. MF Global's missing funds may be massive ploy, CFTC's Chilton. So the $593 million shortfall in client money at MF Global Holdings, the broker that filed for bankruptcy on October 31st, appears to result from a massive hide-and-seek ploy, says Bart Chilton, a commissioner at the U.S. Commodity Futures Trading Commission.
Yeah, well, I've covered this on this show before. I call peekaboo accounting. This was the same thing at Lehman Brothers, and it's used all over Wall Street, all over the world. When the regulators come in to record your end of the quarter liabilities, you simply move it off your balance sheet for a few days with the complicity of another corrupt hedge fund or broker or banker. And then when the regulators move on to the next company, you move it back onto your balance sheet as a reciprocal arrangement with the other corrupt bank or broker or corporation. All corporations do this. General Electric does this. IBM does this. Warren Buffett does this. All the firms on Wall Street do this. They all engage in accounting fraud, peekaboo accountings. And MF Global was caught right as they were in the process of committing accounting fraud, and suddenly that unraveled. The little string was pulled and suddenly went bankrupt. But you could do the exact same thing at almost every single company in America. They're all basically based on accounting fraud. You pull the little string and they all go to zero.
And why this relates to CME Group, of course, is that they're supposed to be, or they were supposed to have regulated MF Global, but obviously they didn't. And Bart Chilton goes on to say, this isn't just a lost and found inquiry. It's a full-on effort to get to the bottom of what appears to be a massive hide-and-seek ploy. It's a distinct possibility, some would say probability, that somebody has done something with the money, and that it's not going to be all of a sudden discovered and an innocent explanation.
Well, of course, that money was just play in this massive shell game that is the cause of 2008 crisis. It's the cause of the global financial crisis. Remember, Goldman Sachs got Greece to play a shell game with their debt. And now they've lost their sovereignty. Now you've got loss of sovereignty with Italy coming up as other countries move in to try and steal their gold. So this whole Ponzi scheme and peekaboo accounting is endemic throughout the entire system. And of course, without any growth anywhere in the world to offset these massive debts, this is only going to get worse.
Now, CME Group blames Occupy Wall Street and Anonymous, but I think you can blame it on blatancy of corruption here, because look at this. MF Global customers can't get cash or answers. Now, this is from Bloomberg, and they're looking at the top 1%, the clients of MF Global and therefore the CME Group. They talked to a 48-year-old New Yorker, Ted Monger, who has had $27,252 frozen in his MF Global account. And he says now that he's thinking about closing his 3 other brokerage accounts because he said, quote, "I'm a high net worth person and I don't want to see $1 million get smoked by another misunderstanding."
This is the thing about the high end, the top 1%. Now they're getting their accounts obliterated by the same terrorists because there's no barrier between them and the money that they're supposed to be the custodian of. They're just completely stealing out of people's accounts now.
Now this guy, Ted Monger, that they talked to, he said he thought the Securities Investor Protection Corporation, he thought it covered any losses due to a meltdown such as that at MF Global. He's now been told SIPC may not cover the money because it was a futures account and faces months of uncertainty as he files a claim seeking recoveries.
Right. Over the past 10, 15 years, all these groups like SIPC or SEC or FDIC are all been undermined by new regulations that supersede them, that make them essentially ineffective and have no regulatory authority whatsoever. And people are now finding this out. They thought their accounts were insured against the broker stealing the money. But now they find out at MF Global that no, the brokers can steal your money and you have very little recourse. And the broker, by the way, has been using your money to make these incredible bets. I mean, Corzine basically leveraged the firm's capital by 50 to 1 or so, paid himself $100 million or so, then extracted that out of the company, and of course the Ponzi scheme collapsed. He stole money. The guy's a thief. Of course, he used to be running Goldman Sachs, so he went to like the professional school of thieving.
Now, SIPC, I want to go over this for the audience here, is a private government-sponsored company that insures brokerage accounts for up to $500,000 in securities with $100,000 for cash in case the brokerage firm goes bust. While SIPC covers losses in stocks and bonds, however, it doesn't cover commodity futures contracts unless defined as specific property under certain conditions.
Right, under certain conditions. I mean, the difference between stocks, bonds, and commodities and futures contracts is now virtually impossible to distinguish because they've all blended into hybrid securities and hybrid trading done on dark exchanges. So now SIPC can say, well, we technically don't cover that because by definition, the securities that we do cover don't fulfill our particular definition. And your recourse, by the way, every time you sign up a new account at any of these brokerage firms, I know when I was working on Wall Street, the second you sign off and become a client of a brokerage firm, it binds you to arbitration by a panel of brokers if you have a complaint. The track record for the industry is less than 2% of people who have their money stolen see anything back.
Monger is one of the many customers who can't access cash in the segregated accounts they once thought were safer than bank deposits and just as accessible. So this insurance product, the SIPC, this private government-sponsored insurance, they thought made them safe. Just like all of these investors, well, it goes back to John Corzine investing in in bonds for European sovereign debt. When everybody there thinks they have credit default swaps, this is another insurance product that people think protects them from their bets.
It goes back to Merrill Lynch because during the late 70s, early 80s, they created this Merrill Lynch combined account of a money market. The whole creation of the money market account was a way for brokers like Merrill Lynch to compete with banks. And then they got the government to create this quasi-governmental, not terribly regulated seal of approval that said these money market accounts are insured, quote unquote. And Merrill Lynch and other wirehouse firms, big Wall Street firms, siphoned billions from the banks because hot selling brokers would call people up and say, oh, your money's stagnating at the bank. You got to be in the stock. Come over to Merrill Lynch. So now we're finding out that all of the support mechanisms that are supposedly keep this cash safe as it in the bank are in fact faulty, that in fact you don't have access to these funds, that the brokers have a license to steal, and this guy's never going to get his money back, and he should be unemployed soon. He's one of the 1% now. But you have to move from talking about the 1% to talking about the 1% of the 1%, because everyone else in that category is now going to go bankrupt.
Well, I'm going to talk about the 1% of the 1%, because in fact, they aren't protected either. When the whole system is fraud, when they exist in a system of fraud and they themselves perpetrate the fraud, they ultimately end up becoming victims of the fraud themselves, because they talk about other clients of MF Global and therefore the CME Group, and they also have been frozen out, including the NYMEX brokers here. So they speak to a New York Mercantile Exchange trader, David Rosen, and he said, quote, "We didn't think we were just customers. We're the ones in the pits providing liquidity so everyone around the world can trade these products." So there you go, Max. They stood aside, these NYMEX traders, they throw things at, Occupy Wall Street protesters and say, get a job. And they don't do anything when those guys had their pension funds, all their Joe Bag of Donuts money stolen. And when they come for their money, when they come from the top 1% of the 1%, who's around to save them?
Yeah, MF Global is like the mafia guy who turned state's evidence on the kingpin of the mafia, because you can't freeze out the NYMEX from the underlying criminal racket that's going on. Because the NYMEX is one of the primary planks that keeps the syndicate up and running, this criminal organization going. So it's like, if you turn in and you tattletale on the dawn of the mafia, you're going to ruin the whole money-making enterprise of the mafia. So you can't let the NYMEX leave it out and hanging. It just shows you how bad the situation is, that MF Global would in effect put a knife in the back of its very own criminal syndicate operator, NYMEX.
But Max, if all of these traders, if even the NYMEX can't trust the system, and they can't trust the John Corzines of the world to not steal from them, they count on a system which you only steal from the pension funds and the passive traders, not stealing from the active traders. And that's where they're going after, the active funds now, it appears.
Yes, this is a very important story because it marks a new chapter in this crisis, in my opinion. Remember, first it was a liquidity crisis. Then it became a solvency crisis. Now it's becoming a systemic crisis. The underlying fabric of the global markets, the thing that keeps them running, is now crumbling before our very eyes. And this is a new chapter in this whole 4-year collapse that was completely avoidable had somebody in any governments, any of the G20, simply stood up and said, we are going to apply the existing regulatory laws to keep these guys in line. All right, Stacy Herbert, thanks very much for being on the Keiser Report.
Thank you, Max.
Don't go away, much more coming away, so stay right there. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to sunny Los Angeles and speak with Mike Maloney of goldsilver.com and protectandsurvive.com, where I'll be speaking next week in London. Mike, welcome to the Keiser Report.
How you doing there, Max?
Fantastic. Mike Maloney, across Europe, member nations are being urged to use their gold reserves to collateralize euro bonds. What are your thoughts on what role gold will play in the final resolution of our global debt crisis?
See, all that gold was originally owned by the people. That was the people's gold. The central banks got it all, and now it's going to get transferred out of the central banks to somewhere. Gold used to back the currencies. Why is it now being used in repayment of debt? I think it's the worst thing that can possibly happen, Max. I think that, every 30 to 40 years, the world has a new monetary system. And before World War I, for most countries, they had a certain amount of gold at the Treasury, and they issued an equivalent amount of notes in circulation, a certain amount of units of currency that matched the number of units of gold that they had. Then World War I happened. The countries in Europe all stopped redemption rights. You could no longer turn in your currency and request gold. And then they lit up the printing presses. And so between the war, we had something called the Gold Exchange Standard, where between the two wars, World War I and World War II. The gold exchange standard in the United States, for instance, the Federal Reserve Act specified that the currency only had to be backed 40% by gold. So in other words, they could put $50 in circulation for every $20 gold piece in the vault. And those $50 all promised to pay gold. So we were putting more receipts for gold or claim checks for gold in circulation than gold. The currency was the paper that circulated. The money, the real stuff, was in the vault, the stuff of intrinsic value. That fell apart during the Great Depression because it was a very poorly designed system. It was a man-made system. It fell apart. And they came up with the Bretton Woods system from 1944 to 71. And there was no reserve requirement. We could print as many dollars as the U.S. wanted to print and only have a certain amount of gold. All the other countries on the planet would back their currencies with U.S. dollars, and the U.S. dollar was backed by gold at $35 an ounce. And then Nixon stopped the convertibility into gold in 1971, and the world has been on a dollar standard since then. So we've gone on baby steps from gold to partial gold backing to less gold backing to no gold backing, where currencies are all backed by IOUs, bonds. Well, every 30 to 40 years, this falls apart. Now we got to go back to something from nothing. If the central banks are going to use their gold to back debt, what are they going to have left when the world monetary system sees this next shift? I think the countries that do that are going to end up being broke, and the countries that still have some gold are going to end up being very rich.
Right. Now, China's, they're massively importing gold, and it seems to be a bit of a wealth transfer going on from the west to the east. Would you concur with that? What are your thoughts?
Absolutely. This is part of something called the 500-year east-west cycle. Every 500 years, roughly, prosperity and technological advancements shift from the east to the west and vice versa. A lot of people don't believe in the 500-year cycle. Some do. I just say that people can feel it happening today, and wealth is being transferred that direction. In regards to gold, for years, Western central banks were suppressing the price of gold by selling it into the market. Now, we've got, the past couple of years, central banks are net buyers of gold. This is a huge game changer. I wrote an article a long time ago, When One Country Blinks. That is happening right now. Countries are they're in a showdown, and countries are starting to blink. Venezuela asking for their gold. When the rush happens, I think you're going to see gold be going like this and this and this, and then suddenly, bam, there could be gap up days where you see the price of gold go up 30% or even double. You wake up in the morning, the price is double what it was last night.
Well, certainly as you get further into a bull market, you have different dimensions of that market occur, and that kind of volatility, I think, is to be expected. Now, speaking of wealth transfer, since September 29th in the U.S., 650,000 customers have transferred $4.5 billion out of big banks into credit unions and community banks. How much more impact on the fraudulent banking system would this protest have made if each of these 650,000 customers had bought just 1 ounce of silver?
Well, the silver market, I'm not sure the size of it right now. It used to be that the silver market was 1/300th the size of the gold market.
My understanding is that this above-ground silver supply is roughly worth about $1 billion. So here you have 650,000 people. If they each bought 1 ounce at this type of a level, they would have probably tripled the price of silver.
Yeah, you'd have $200 silver or $150 silver, something like that.
And would that have made a huge impact on the psychology of this market?
Yes, it would. I've been saying since 2002, $100 silver is an absolute no-brainer. And I'll tell you, when silver was $4.30 an ounce, $4.50, $5 an ounce, people thought I was a lunatic. And now that it has already hit $48 an ounce and then done a pullback, they're going, well, maybe he's not a lunatic. Now it only takes tripling of silver. Well, silver was $50 back in 1980. Name one other thing on this planet that's selling at a discount to its 1980 price, Max.
Computers. But, of course, that's another story.
That's a good one. You got me there.
Due to hedonic adjustments, that cheapening of the central processing unit of a computer is considered to be deflationary in the mix that the government reports. Therefore, the price of food and energy, the fact that they're going up, don't pay any attention to that. But speaking of fraud, what are your thoughts on the CME Group and MF Global story? Does this story have any significance for someone who may be invested in gold and silver via the paper market? MF Global, of course, was caught stealing customer money.
It's all going to have an impact, but I consider all of the things that are currently going on short-term noise in the big picture, the big scheme of things. No fiat currency has ever survived. In 1971, we began a grand experiment where all the world's currencies became fiat all at once. This is proven thousands and thousands of times that this does not work. There is no example of any fiat currency before 1971 surviving. They all eventually fail. So my real target for gold eventually is infinity dollars of the type of dollar that exists now, the unbacked fiat currency dollar. That will go to infinity dollars per ounce as far as the gold price. My target basically is gold should be higher in price than the points on the Dow. It should take 50 ounces or less probably this time around for gold to buy a single family median price home in the United States. So per ounce, 1/50th of a single family median price home or 1 share of the Dow. That's my price for gold. All of the things, they're all going to have an impact, but it's just one of the little jags on the way up to infinity.
Okay, so let's talk about that gold Dow ratio for a second, because it's historically interesting. There are 2 times in the past where the Dow Jones and gold have reached 1-for-1 parity. 1980, of course, the Dow Jones was at 800. The price of gold was at 800. Then I think you go back into the 1930s where the price of gold was something on the order.
Actually, the price of gold was $20.67 an ounce on a day where the Dow was at 40.22 points.
40, the Dow Jones was at 40. Boy, that was a good day to be long the Dow. But it was so at the 1-to-1 parity using this rule of thumb, you're saying gold with the Dow Jones at approximately 11 and 12,000 an ounce. Let's say the Dow Jones comes in and we have a 1-for-1 parity anywhere between 5,000 and 10,000 on the Dow. Kind of, is that what you're saying?
Yeah, if we go into big deflation, maybe gold peaks at $3,000 an ounce, but the Dow will be 1,500. I believe you're going to see a day where gold will be double the points of the Dow, simply because if you look at the Dow-gold ratio, it goes into a bubble and then it overshoots to the opposite extreme. It goes into a bigger bubble, overshoots further to the other side, and then we went into the biggest bubble in history recently, and it's reverting now. It's down to about 7 ounces of gold for the Dow, or in other words, gold's price is 1/7 of the Dow. But since we're coming off of a point where paper assets were more overvalued in the year 2000 than at any time in all of history, PE ratios were insane, dividend yields were non-existent, and we're reverting back. It was 45 ounces of gold to buy 1 share of the Dow. So gold's price was 1/45th the points on the Dow. It's currently 1/7, so gold is catching up. But we've been so far out of whack that it's going to overshoot further to the opposite extreme. I think you're going to see gold at double the points on the Dow one day. I think a target of equal is a very sane target. That's normal. But if we go into a deflation, you could see gold at 3,000 and the Dow at 3,000 or even 1,500 if it goes to double the points of the Dow. If we go into hyperinflation, maybe gold would be $30 trillion an ounce, and the Dow 15 trillion points. And still, gold will buy you the same amount of shares of the Dow, regardless of whether it's deflationary or inflationary. Gold's purchasing power should rise 7 to 14 times compared to stocks. In the year 2000, gold was the most unloved and ignored than it had ever been throughout all of history. For the first time in 1971, from then on, it was no nation's money. From 1980, it went into a brutal bear market from 1980, where it hit $850, to the year 2000, when it was only $250. And It's up at 1,800 roughly, so it's just barely over double from its 1980 high, and they've created about 10 times more dollars. I mean, how many things are just double in society what they were in 1980? Almost everything is up far, far higher than that.
All right. Well, certainly, it's 15 trillion or 30 trillion. It sounds like really absurd numbers, but remember back in the Weimar German days in the 1920s, the Reichsmark went from a 1-to-1 ratio to the U.S. dollar to 5 trillion to 1 to the U.S. dollar. So getting into those trillion numbers, historically, you do see that from time to time. Mike Maloney, we're out of time. Thanks so much for being on the Keiser Report.
Thank you so much, Max.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Mike Maloney. He's on Twitter at Mike_Maloney. You can follow me on Twitter, and please follow me on Twitter. I'm trying to stay ahead of Stacy Herbert on Twitter. And you can send me an email right here at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.